Over the last few years, portfolios that have had, been sort of dominated by equity exposure have actually done pretty well. So traditional balance type structures that have had fairly fixed asset allocations have actually done quite well. But just because they've done quite well in a particular environment doesn't sort of say that that will continue going forward. So I think as these dynamics change, as volatility inevitably starts to pick up, as the policy challenges start to become greater, both for policymakers and for investors, markets are going to start to move. And probably not up, probably down. And so strategies that allow investors to move away from those assets that are most vulnerable have greater breadth in terms of the sorts of investments that they can make, whether that be in currencies, whether that can be profiting from changes in relative prices that might occur in these environments, I think are going to be quite beneficial. And when we think about objective-based type portfolios which have that flexible asset allocation element very much embedded within them, the key idea is really to give us the flexibility to make the investment decisions that align the portfolio most closely with the objectives of the investor. And those objectives are consistent real rates of return or consistent returns above cash, low levels of volatility, but particularly to preserve capital and protect the investor in environments where markets aren't doing all that sort of free and heavy lifting. So I think it's important to have flexibility, true flexibility in the sorts of positions that you can have in portfolios to enable those objectives to be met in all environments, not just environments where equity markets are rising. To give you an example, our objective-based portfolios at the moment have equity exposure in the low 20% range. And that's about as low as it's been in the last 10 years. Compare that to a balanced fund, which even a defensively positioned balanced fund would still have equity exposure somewhere in the order of probably 45 to 50% in equity. So if equity markets fall sharply, those strategies will struggle to deliver positive returns to investors.